Let's check in on how the Kenyan markets are faring for the second day of trade this week. Looking at the overall blue chip index, 4,546 points, another day in the green. Looking at the top gainer, CFC Stanbic, that stock up at 53 shillings. It's a rally there of almost 10%. Of course, we know CFC Stanbic, owned by Standard Bank here in South Africa, which reports its overall group results tomorrow. Crown Berger, the second best performer, up 8.2%. And on the losers front, Kendall Coble, another day in the red, shedding 6.8%, and BOC, that small cap, almost 5% in the red for the day. And looking at how the currency is faring, has seen some weakness today, 1.5% in the red. That's against the greenback, down 1.5% rather, 86.9. A little bit of jitters in the markets right now with the election results still unknown, and some fears perhaps about those who aren't said to be in the lead contesting the election process. But let's get into all of this. So crossing over to Nairobi, Johnson Nderi, investment analyst at Suntra Investment Bank, is standing by. Johnson, thanks for your time today. So of course, you still don't know who your president is. I'm sure this is causing a bit of apprehension in the markets.
Yeah, it definitely is, and like I was seeing in your screen there a couple of seconds ago, we've seen a dip in a weakening of the shilling against the US dollar, and that kind of sums it up. But we're still taking the positives. At this time last year, things were much more heated up, but this time round again, I think everyone's realized the importance of maintaining the pace. So at this point, I'd like to look at the positives and say so far so good.
Mm-hmm. Looking at the impact that this will have on the economy going forward, given the fact that we've had a few days of, I suppose, most businesses being shut, do you see that as a big issue in terms of productivity losses?
Yes and no. For some businesses whose inventory is based on time and highly perishable goods such as airplane seats or hotel beds, that might be a concern. Mm-hmm. But for others who rely on cold hard inventory goods and those might the demand might be pent up, and when unleashed, you might see a huge surge just to pick up from where it left off, and then it smoothens out. So it depends on what industry you're talking about. I'd have more concerns on service industry, which time is a huge factor as opposed to the goods and services, goods sector, mm-hmm. where demand can always catch up.
Let's just look at some of the stocks today, because I mentioned that CFC Stanbic almost 10% in the green, a strong rally coming through there. And we know the overall Standard Bank group is reporting earnings tomorrow, but how's its subsidiary in Kenya been doing? What are your expectations for the bank relative to how the other banks have performed so far?
Well, so CFC Stanbic, and they're having an investment presentation incidentally locally tomorrow with us as well. But they had a sterling year. Profits, I think, were up more than 60%, really because of largely a turnaround in the retail business. We expect corporate business to continue performing as well. So very strong results released on Friday last week, which is really what is partly driving up the share. The share also had been seemingly undervalued. It was trading below book value, and because of that, it had quite a bit of headroom to rally up. And so part of it is playing catch up. The other part is, acknowledging the performance of the bank itself.
Mm-hmm. But given the fact that, of course, it has the backing of, I suppose, Standard Bank is the largest banking group in Africa, would you see that as a reason to buy the stock relative to some of the other banks, which, of course, have a stronger foothold in East Africa, but don't have that continent-wide exposure?
Well, we've got Barclays, which has ABSA backing it. We've got Standard Chartered, which has got Standard Chartered PLC backing it. So we've got similar banks, and again, it depends on how what you're looking for. The positive part of the indigenous banks is the ability to grow in the region. CFC Stanbic, like Barclays and Stanbic, and rather and Standard Chartered, are confined really to grow in Kenya, although CFC Stanbic has quite a bit of a regional presence. But the likes of KCB, most growth is enjoyed by the shareholder here, as opposed to Stanbic growth, which might be shared out with South Africa. So there are arguments for both. One in terms of stability, because of a strong backing from down south there, but the indigenous here also have more room to grow, if you could say that, and each offers a different risk reward play.